Let's get specifically back to the markets, earnings. Thus far joining us is Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. You see a pretty good year, I think, Lori. Maybe not near term, but 8% total on the S&P by the end of the year.
Yeah, so we're at 5150, and we're trying to guess where the index is going to end up on December 31st, so it's a year-end number. And, you know, what's interesting is back in November, we had a 5,000 target that we set for this year. It was about a 10% return. So the anticipated return we're looking for is a little bit lower than we were a few months ago, primarily because of that big move we had in the fourth quarter. But, you know, our number's higher, and we have to mark our models, you know, to the market. But I think it's going to be a good year. I think we're going to make progress. You know, with an 8% return, I'm still one of the more bullish strategists out there, which is sort of an interesting factoid in and of itself.
But even though you would characterize sentiment as somewhat overdone, frothy right now, that explains the reason why we might see some near-term weakness.
Yeah, and I think it's important to distinguish how frothy sentiment is. So if you look at the AAII survey that comes out every week, and this is an oldie but a goodie, you know, it's popular for a reason. We've been about one standard deviation above the long-term average in terms of net bullishness. If you look where we were kind of starting in early December through about a week or so ago. If you look at a back test on what that means for performance over the next 12 months, you're typically flat in the S&P, I think a gain of about 0.7% on average, but you're still up about 6.5%. So I think that does a very good job of articulating sort of the short-term risk, but longer term, you can still get back on track. It's a different story if you're at two standard deviations. Then you're typically down over the next 12 months.
Looking under the hood, you point out that the drop in rates started the long-awaited broadening of the market in the breadth and through the small caps. But recently we've seen a backup in rates.
Yeah, it's really remarkable.
And it stopped, and we're back to the big caps again, right?
We did. I mean, you know, investors were complaining about whiplash and narrative to me last year, and we're really kind of hoping things would settle down and sort of stick with the trend. And we've gotten whiplashed once again, you know, as the new year has gotten underway, and everything that was sort of working that got people, frankly, really excited in the fourth quarter has just gone back to the same old, you know, sort of large cap concentrated top 7 names.
We can do, it's always fun to try to, you need a calculator, but we take an S&P total earnings for the year, and you were higher. You were at 244. Oh no, I'm sorry. Bottoms up consensus is at 244 to 245. You're not there. You're below. You're at 234. So if you put a multiple on that, it's interesting you're still at 8% for the year. Yeah, and that's where, you know, we're below consensus on earnings. We're not baking in profit margin expansion the way bottom-up consensus numbers are. That's a whole, you know, other conversation. But on the multiple, we're actually above consensus. Yeah. So we've built a model going back to 1962. We bake in inflation, we use PCE, 10-year yields, Fed funds, and GDP. And we use that to basically forecast where the PE in trailing terms should be at the end of the year. That model spits out 23.2 times. I will tell you, Joe, that model last year was consistently pointing to 4,700 to 4,800 on the S&P and a much higher multiple than a lot of people assumed. No one saw that, yeah.
You're just analyzing the numbers and the trends and the sentiment and putting it, I mean, you're not getting carried away with anything. You're just looking at real...
People who like me, and not everybody likes me, by the way, but people who like me say, Lori, what we love about you is you're just all about the data. Yeah. So we let the data drive the narrative. And I'll tell you, this valuation study was fascinating. I'm a big believer that we're at the beginning of the post-COVID era of investing. And if you're just using post-GFC, pre-COVID rules to do your analysis, you're missing the boat. So our valuation model, what I really learned in doing that work is that in the 70s, inflation did a better job of explaining PEs than interest rates. And I think that's exactly what happened last year. GDP doesn't always do a great job of driving PEs, but we actually found when we were building the model, I didn't have GDP in there to begin with, but people kept asking me, plug in this number, you know, plug in that number. They wanted to know if we stress it for certain GDP ranges, you know, what would the multiple be? So I threw it in, and it actually helped the model a little bit. And we realized that last year you were actually seeing the fact that GDP, you know, kind of going to Steve's conversation, the fact that it was recovering and coming in ahead of expectations, that was really helping support the multiple as well. So if you go back and look at history, you learn a lot of stuff that people missed last year.
That's interesting.
And it's an election year. Right. You don't give a crap.
I care. I'm actually...
Not yet. You haven't decided yet. I just read the notes. It's an election year, but people are asking you about it, but you don't really have a firm answer one way or another.
Well, no, we do have a firm answer.
So,
what we've said, we have 5 different pieces of quantitative analysis that go into the 5150 target, and one of those is actually how the stock market behaves in presidential election years. It tends to be, based on when we run the data, about 7.5% return. And so we've told people stocks tend to be able to adapt to any political environment, right? But there is uncertainty that happens when the guard is changing. And if you look at the historical return, it's positive, but a little bit below trend. So this uncertainty always weighs on the market. We think that uncertainty is still in place right now. I have European and Canadian investors wanting to talk about almost nothing else but the election in my meetings. We try to save it for dessert if it's a dinner meeting, just so it doesn't derail the whole thing. U.S. investors haven't wanted to talk about it as much, but I will tell you the Iowa caucuses the day after, that is all that my incoming was about. So I think people are starting to look and think about sector trades. And we've said, it's really too early. We don't have a lot of policy yet to analyze. But people are starting to go there, not just overseas, but in the U.S.
See, you gave me some data on what happens during election years. But what I meant, you're not really saying it one way or the other. But you are thinking about sectors based on who the eventual winner is? Is that?
Clients are asking me about it. I think it's too early to make big calls, but those calls are starting to come in.
Okay. Lori, I don't know about other people, but I like you. That's really straightforward.
I appreciate it. I like you guys, too.
Appreciate it.